Welcome to the It Is What It Is podcast. Today, I want to talk about the economy and the current uncertain macroeconomic future and the general shifts in the market that are unseen and unheard. Things that are not on news headlines on Yahoo Finance or CNBC, but the money movement that's happening behind the scenes that isn't really talked about. I'm going to share with you my assumptions and my thought process, but by no means is this a crystal ball and a definitive prediction of the future. It's more or less a way of understanding why the market's behaving how it is and why the future, in my opinion, doesn't look that great. So, first, I always think about who has the money and where is that money going. And that sounds very simple in its form, right? Where is this money going and who owns this money? But it's a little bit more complex than that. So right now, a majority of the wealth is concentrated, at least within the public markets, within like the top 7 companies of the world. Two of them have not IPO'd yet, which would be Anthropic and OpenAI. But essentially, these companies are pretty much a almost acting like a monopoly or an oligopoly for how much they control the market. Not even from like a business perspective, but just from a weighting perspective when you think of the different indexes and funds that try to get market exposure to the market, where they're at least 10 to 20% of like most funds that just want general exposure to the broader market. And that basically means that most Americans are invested in these companies one way or another, given in not only one way or another, but to a fairly high extent, just given how far reaching these companies are. Additionally, when you think of the money that's flowing out of these companies into what they're investing in, that has given rise to the economic boom that we've seen within like the chips market and the semiconductor market, where you're seeing like insane 1,000% growth in like the last year for some of these semiconductor stocks, specifically memory. So it's almost a circular functioning of logic where you as an investor, whether you're a enterprise investor from like these large financial firms or private equity investor or even like a normal person, are going to be exposed to these large companies, like these 7 or 8 large companies, regardless. And you will be investing your money there no matter what. Then all these companies are trying to become the de facto platform for AI, which means they're pushing all of their investments into semiconductors to then power these large companies. And the goal is then who's going to buy these products? You as a consumer or you as a business. And it's a pretty self-perpetuating cycle. And to be honest, I'm describing like any market economy, right? Like you as a person will work a job, you'll work a job, buy food. The food goes back to you, but then the farmers get paid, right? And the farmers are people too, so then they buy your services that you create, and it kind of goes in a circle. The reason why I bring this up of this circular logic is that before, there used to be more decentralization and more democratized control in terms of how this money would flow. As in, the people really had a lot more power and say in terms of what was being invested in. Now it's quite the opposite, where yes, retail investors do have some ability to impact the market. I mean, we've seen GameStop, that basically was a crazy pump and dump of a stock. We've seen crypto, but essentially these companies like Facebook or now Meta, Amazon, Google, all of their money is just flowing into these semiconductor companies, or indirectly flowing into these semiconductor companies, because of how they want to support their AI services. And it's the difference between like them just writing like a several $100 billion check versus like each person individually contributing like $10 or $20, right? Or like $100 or $1,000 to invest in a certain company. And these moves within money are creating a ripple effect where there is basically like a large block of money being moved, and that first mover advantage influences everyone else, right? And to give like a more concrete example of this, the reason why Nvidia is the most valuable company in the world is because everyone's buying their GPUs. And Nvidia then will need to buy processors, memory, components, and that's why every other semiconductor company has gone up in retrospect. And it's enough movement in money, which I think is unprecedented, where it fundamentally changes the market capitalization of these companies and therefore the weighting of these companies within an index fund. And now your index fund is now by default funding these companies. And I think the most recent example of this was the IPO for SpaceX, which everyone talked about, where you're now being forced to invest in this company because it's worth, on paper, over $1.5 trillion. But this is very, very scary, because essentially now that the control is now centralized within a group of very, very few people or companies, they basically dictate the economy for everyone else. And that then trickles down to everyone's day-to-day lives, which then creates an even higher level of wealth disparity and income disparity between people. And this is just my personal take, but I think that the wealth divide is what's contributing to both a political divide and a generational divide and a health divide within this country. And this is a very complex machine with many moving parts. But when a select few group of people can make those decisions, then it impacts all of us. So what does that mean for like normal consumers like you or me that are just have a 401k and they're just investing in the market passively, and just the common advice is to invest in an index fund? Is that it used to be that index funds were a way to diversify your risk. The old saying of putting all your eggs in one basket is literally why index funds exist, to basically distribute your risk. But as your risk becomes more and more concentrated over time, and the distribution of which companies you're investing in are becoming more and more siloed to either one industry or like one space. That is both very scary, but also could technically have a lot of upside as well, right? The more risk you take on, technically the reward is much higher. The thing is that in the same way these companies and these very wealthy individuals can make these large money moves that we retail investors can't just, whip out a couple $100 billion and just move money around, means that we will always be on the back foot and we are no longer driving the narrative of where investment goes or where money goes within this economy. So this is why you also see a downstream effect of money being moved more into gold as a store of wealth over the US dollar. You're seeing money kind of flowing in and out of treasury bonds and yields like quite rapidly, and yields are changing really quickly because money's being deployed and sucked back in and deployed and sucked back in for these like very micro adjustments compared to like long-term investment principles of like multiple years, right? You're seeing markets go up and down, some stocks going up like 10-20% or down 10-20% in days, which is you pretty much unheard of. And you can argue that it could be like the quant trading firms or market manipulators, which is all true, but the macro effect of this money movement is that the market as a whole has become more volatile and more crazy for everyone. And the risk profile for everyone is now increased dramatically. And it's really, really true now that the market and everyone's wallets is becoming more and more homogenous, where we are truly, truly all tied together and we're more in the same boat now more than ever. And this tie to all of us is risky, but what makes it the most risky is that really the direction of this giant ship that everyone's on is not directed by the people. It's directed by the people who have money. So in a long-term sense, there is really not much you can do as an individual than just amass a ton of wealth and protect yourself and diversify your risk away from the market if you can. That's not to say that if all the money's flowing into the market, then you're going to be missing out on a large opportunity as well. So it's just very volatile in either direction. But it's just very, very scary to think about how the market is running this way, because even now the government is also trillions in debt and now is even more investing into different AI and R&D initiatives, and has even taken, for example, stake in a public company like Intel. So the government is now even more involved in businesses. And when you look at the state of tech companies as well, they are trying to get more and more government contracts and public funding in general as well, which means that your tax dollars are now going to these companies in general, which makes the economy even more intertwined. So not only is the upside of these large companies going to benefit you, it will also benefit the government. But at the same time, if these companies fail, then the government will also take a hit, but then simultaneously you will take a hit, and it will be a very, very hardcore downward spiral. So this is not to be bleak or to be like pessimistic or like a doom prophet foreseer in this retrospect. It's more or less to say that like it used to be the circle was pretty wide and large and it took a long time for money to move around this circle, but now this circle is so tight. It used to maybe be like back in the day that it would take $1, maybe, I don't know, let's just say it was completely random, like a year for the money to go around from you all the way back to you again, right? Now money is moving so frequently and rapidly that the circle is becoming almost instantaneous. And the circle, imagine like a circle that's really, really large in diameter, right? That takes longer to go around. The circle has now become so small and the money's moving so fast that we're so inextricably tied to each other, where if one fails, we will all inevitably fail. And there's not really a way to de-risk this short of just not investing in the market, but you can't really not do that. And the market touches everything. So I think that this, in my opinion, marks a very different shift in investing in market mechanics than it did a decade ago or even 2 decades ago. I think that you really only have two choices now as an investor within this economy. And it's either to get on the ship or get off the ship. And unfortunately, it's like a make or break decision. It used to be you could maybe put some on the ship and put some off the ship and then it would marginally work out. But now the ship could go up 100% and go down 100%. And you only have one option. You really only have the ship because everything's tied together. I will tell you what I'm doing personally as someone who's investing my money is to be very, very careful about these cycles and very, very opportunistic in the way that I both invest my capital and I invest my time horizon. Where, yes, the traditional advice of just putting it into an index fund and letting it sit forever would technically still be true. It's not as though the entire premise of long-term investing has gone away entirely, but the system has definitely changed. And I'm looking for alternative assets to invest in that maybe are not the most traditional, and to try to diversify myself in a way where I'm not beholden to this ever growing centralization of market cap dominance of a select few companies. And this is where it gets difficult for everyone, because when you start to see this change in the market, it really does explain a lot of the downstream effects within society. And I want anyone who's stayed this far in the episode to know and understand is that now more than ever, with social media and AI and an even more connected but yet disconnected society, that it will take a lot of self-awareness and patience to dig through the surface signals to get to the true root cause, which, in my opinion, always comes down to how money moves within the market. I think that the economy and economic factors are the largest contributor to any sort of logical or social issue that may exist. So I hope this helped. I hope that this doesn't scare anyone. I think it's important to acknowledge the shifts in the market. What you decide to do with your investments and your money is something that everyone will have to eventually figure out. I think that we are in a pretty significant transitionary period right now where the market really has not settled or corrected yet, or is maybe just starting to correct as of today to a very slight degree. But No one has a crystal ball. No one can predict the future. Anyone who claims they can predict the future is just wrong. Maybe wrong a certain percentage of the time and then right another certain percent of the time. But I digress. Anyways, thank you.